All right. Hi, everyone. We are live. My name is Katie Kuntz, and I'm a social media editor here at CNBC. Welcome to Market Matters. I'm joined, as always, by CNBC's senior stocks correspondent, Bob Pisani. Hi, Bob. How are you doing?
Well, I'm catching my breath.
Yeah.
Yeah, I have been at CNBC 32 years and 25 years as the stocks correspondent, and this is a week for the record books. This is one of the most amazing weeks. This will go down in history this week.
Yeah, for sure. Well, we have a lot to talk about this week, so let's just jump right into it. What's been driving this surprising market rally that we've been seeing?
It's pretty breathtaking. We've rallied 1,600 points on the Dow in a day since yesterday morning. That's like 5%. That's a lot. I think there's a couple things going on. First off, there's this rather amazing announcement this morning that the Russians might be interested in negotiating with the Ukrainians in Minsk. This is astonishing because essentially, if you're following what's happening, they're invading the country, and it looks like they're going to, set up a puppet government there, and so they might want to just negotiate with the puppet government. This is amazing, but the market actually did rally on that because the chances of reducing the conflict or ending the conflict or whatever always intrigues the markets. The other thing that I think is very important that we're seeing is the economic data is very good. Outside of this terrible news in the Ukraine and what's been going on, the data is very strong. Remember, markets respond to economic data. So you have to look at it that way, dispassionately to a certain extent, despite the personal tragedy and the awfulness of what's going on in Ukraine. The reopening story is very strong. The U.S. economy is still doing very well. We had some economic data this morning that was good. The PCE deflator, which is what the Fed uses to watch inflation, wasn't as bad as some people were afraid of. We had some other data, personal income, that was very good. Spending, durable goods were good. One thing very interesting, the home sales numbers were not as strong as expected. I think people are starting to push back against these crazy high home prices and even maybe some elevated mortgage rates. I think that's not bad. I think that's potentially good. You got to figure out some way, how do you stop this inflationary spiral? And people have to start pushing back a little bit on it. You have to have what's called demand destruction. People got to say, no, thanks. At that price, I'll walk away. So in a sense, that might be some good news about breaking the back of inflation. Remember, that's what everybody's worried about. What are we going to do about inflation? So believe it or not, we're up slightly for the week. With all of this craziness, the S&P is up slightly. And by the way, professionals use the S&P 500, not the Dow Industrials.
Yeah, so you mentioned inflation, and there's been a lot of talk about what this might mean for the Fed. So can you kind of tell us a little bit about what the Russia-Ukraine crisis that we're seeing right now could mean for the Fed?
Well, I think the reason, and again, you have to separate the fact that the stock market responds to economic issues, not human tragedy. And this is a human tragedy and a disaster for democracy in the Ukraine, obviously. But the stock market responds to economic data. And the reason we've been rallying is, number one, there's a belief that so far these existing sanctions they're putting on, particularly there's no sanctions on crude oil exports. This is going to limit the economic impact from the Ukrainian crisis on the markets. So in the coming weeks, you see what's going on here. I don't know what's going to happen, but you see the trend here. It looks like Russia's going to try to establish some kind of puppet government over there in the Ukraine. And the markets will now look past that and focus on what else they need to look at. And that's the Federal Reserve. So we're trying to figure out, are there going to be more sanctions here on Russian and Ukraine, particularly energy, commodity, restrictions on stocks, for example? Does the conflict spill past the Ukraine? Remember, before the Ukraine, though, the biggest worry was the Fed. The worry was the Fed was that they were going to hike rates so aggressively to combat inflation that they'd essentially kill the economic recovery. That was the biggest worry for the stock market out there. And the rally yesterday and today is partly on the hopes that geopolitical uncertainty will reduce the chances that the Fed is going to be really aggressive raising rates. Everyone agrees the Fed's going to raise rates. But there are a lot of people who think they'll try to raise rates 50 basis points in March, which is a lot. Normally they do a quarter point at a time. And there's now the majority who think they're not going to do that. They're only going to do 25, and then they'll do a series of 25, which the market probably can handle if the economy holds up. So, there is bets being made about how much is this global turmoil affecting the Fed's thinking. In theory, in a perfect world, it would only affect them if it affected their dual mandates of employment and inflation. Well, arguably higher oil prices and, that's inflation. So that should be a factor in their thinking. This is what the market is hoping for right now. So this is all really complicated. Remember why stocks are having a problem. Number one, inflation. Normally, in moderate inflation, companies can raise prices, and so the stock market does very well. But when you have rapid inflation, you can't raise prices fast enough in a lot of situations, and it gets out of control. That's a worry for stocks, number one. Number two, you have the whole situation with the Fed raising rates. Again, in a good economy, the Fed can gradually raise rates and it won't hurt the stock market. But if the economy is weakening and the Fed is aggressively raising rates, those two combinations, that's bad for the stock market. Historically, that's always been bad. So there's a lot of game theory going on here. What are we going into? Is how much is inflation, for example, high oil prices going to slow the economy? Well, we don't know. This is very hard to figure out, but we do know that much higher than expected inflation, combined with the Federal Reserve raising interest rates, combined with a slower economy, that is a bad combination. If this doesn't turn out to be that much, if we don't have to raise rates as much, if inflation calms down, and if the economy remains strong, well, then the stock market's going to go back up for sure. We just don't know. That's why the market's all over the place. Nobody quite can figure this out right now. So there's a lot of bets being made in a lot of different directions. It's a very fun time, but also very confusing and a little bit worrisome.
So let's jump into the energy sector in particular. What does this crisis mean for the energy sector, and how is it impacting that?
Well, look what's happened to oil stocks. First off, nobody cared about oil stocks for years, right? It got so bad that oil stocks, even including ExxonMobil and Chevron, were only 3% of the S&P 500 by market capitalization. 3%. That's like nothing. Nobody cared about it. There aren't even any. There's not many oil analysts around because it's not even been worth following oil stocks for years. So all of a sudden, energy becomes a big thing again. You can imagine this is a great year. Look what they've done to oil. Oil is up 25% this year. Big oil stocks are up 25% too. And oil companies, they're making a ton of money. I don't know if you saw Occidental Petroleum. This is one of the big exploration and production companies in the world. They reported the numbers yesterday. It was astonishing. They just made gobs of money over the transom. I'll give you an idea. They reported the average price they were selling a barrel of oil at was $75. They're going to make a lot more in this quarter. It hit 100 yesterday. It's in the low 90s now, but they're making more money. They're making so much money that they have record cash flow. Cash flow is what's left almost at the bottom line after you paid all your expenses. They've got so much cash coming in. They're using it to pay down debt, number one. They're using it to suddenly have a real dividend. They had a 1 cent dividend. It was nothing. They've now jumped it to 13 cents. So they're going to pay 1.3%. So they're actually going to have a dividend. And they're buying back stock. That's the trifecta. When you have a lot of cash flow, you reduce debt, you increase the dividend, you buy back stock. And these companies are going to report amazing numbers. And that's why they're up 25%. The question is, how much more can they go up until the point where they get stupidly overvalued and people say, I don't care, even if they are making more money and they're pumping more oil, it's too high priced. It's always about the price. Remember that. The good news is these oil companies should be a little bit more important part of the business. For a broader question, there's a whole debate going on now about how can we continue to supply fossil fuels because we're going to need them, and how can we still transition to a cleaner energy environment in the future to do that. one of the things everyone has noted this week is Germany, for example, decided they wanted to go whole hog on going for renewable energy. Well, they had nuclear, and they're decommissioning their nuclear power plants. Well, now they're stuck. They've got a problem with oil prices through the roof. They're going big into natural gas, but they're making deals with the Russians to get the natural gas. You see? So in retrospect, we needed to get a better transition. Everybody's in favor of going to cleaner energy. Everybody, I am, but we need to get a transition here, and they're caught right now. That's why they did this natural gas pipeline with the Russians. That's in tremendous doubt these days. So it's a very interesting time to be an energy analyst after years where nobody cared about them.
Yeah, it's certainly interesting right now, of course. So another thing that you had mentioned that I want to dive a little bit deeper into is inflation, something that's on everyone's minds right now. How is the Fed going to combat inflation?
Well, traditionally they raise rates. that results in some kind of demand destruction ultimately. The good news is that inflation itself may create some demand destruction. Everybody's complaining about inflation. I'll give you an example. Carvana is a big car company. Now, they're publicly traded. They had their report out yesterday, and they came out with a very interesting statement. I'm going to read it to you here. Hold on, let me find it. This is a statement from the company. High used vehicle prices have a significant impact on industry-wide used vehicle sales. Higher prices reduce affordability, leading some buyers to forego or delay their purchases. So used car prices are up like 30%. Carvana just said that some people are walking away from buying used cars because they can't afford it. Is this good news or bad news? In my opinion, this is great news. I love this because this is what is called demand destruction. People are walking up to these prices and saying, you know what? I'll pass. No, thank you. And that's what has to happen to sort of break the back of this cycle, this spiral of inflation. People have to walk away. I just took a vacation. I went to Key West in Miami for a week with my wife. Now, I've been going there for 40 years. I know those Key West very, very well. I know what hotel prices are like in Key West. They were double what they were 4 years ago. I mean, really double, not like, 20% higher, and I'm exaggerating. I mean, they were double. Now, that is shocking. And I know wage costs are up and, costs of buying garden hoses are up and all that. But I don't think it's double. It seems like that was really, I felt put upon. I mean, I was a little shocked by it. And I tweeted it out, and several people tweeted to me and said, well, Bob, the hotels are full, as you noted. So people were paying it. And what you need is people like you, Bob, to walk away and say, you know what? No, thanks. I won't go on my vacation. And they're right. And that's what Carvana is saying. Some people are walking away. And so that will help break the cycle, the back of inflation. When all of a sudden, if the hotels can't charge, $800 a night, and I'm not joking, $800 a night for hotel rooms, and they have to go back to $400 a night or $500 a night, something like that, because nobody's paying it or they're not filling the rooms up, that's going to help break the cycle of inflation. So again, you asked me about the Fed. The Fed really has one tool here. They can adjust the money supply and they can raise some interest rates. But let's watch this thing with the home sales today. That's very interesting. And we've had several years where home prices have gone nowhere but up. I think this may be the start of finally stopping this crazy spiral of home prices. And let's see about other things as well. Again, we got to work out these supply chain problems, but I am starting to see some resistance, and I think it's great.
Yeah, it'll definitely be interesting to watch, how that might change as we go forward, especially as the Fed starts to increasing rates. So another question that we got, Bob, was about, what investors should be doing during these kind of times. What do you think investors should keep in mind during times of uncertainty and geopolitical turmoil like we're seeing now?
Yeah, I know this is hard to swallow, but the best advice is to do absolutely nothing. The worst thing you can do is decide, oh my gosh, I'm going to sell now. Think about this. If you would have sold yesterday, the market's rallied 5% in 24 hours. Did you feel like a dummy? You'd say, like, what the hell happened? And the reason that you shouldn't do anything is if you have a long-term plan, pick a date, if you're 35 years old, do you think what's going to happen in the next month is going to impact the stock market, forever? Well, if it's some kind of global conflict, yes, but the probability of that is just very small. You'd have to go back to World War II, literally, maybe a little parts of the Korean War, to have prolonged conflict affecting the global markets. Most of the time, you're going to be surprised to hear this, most global conflicts don't have a long-term impact on the stock market. Most of them don't have an impact because they don't impact the global economy. I know this is amazing to you, but most of these short-term military events that we've had since World War II, they've been short-lived and they don't affect the markets. I have a friend, Sam Stovall at CFRA. He's a great market historian, more so even than I am. And he looked at 24 events since World War II, including the Tet Offensive, stuff in Vietnam and other things, and found that there was short-term impacts from these military encounters of about 5% on the S&P, but usually it took about a month to resolve it, and the market recouped most of the losses within 2 months. Think about that. And the reason, again, is these events, World War II is an exception, obviously, do not disrupt global economic activity. And before everybody gets outraged and says, well, that's a very cold-hearted way to look at the world, that is the way the stock market looks at the world. I'm not saying we shouldn't care about the Ukraine. I care very much about democracy and what this man Putin is trying to get away with. But I'm trying to describe how the stock market operates. So don't yell at the stock market for, being what it is. The stock market is not a human being. It just reacts to investments, and that's what's going on right now.
Yeah, I definitely think it's good, and important to keep that historical context in mind, during times like these. So thanks for that, Bob. Our next kind of topic that people were asking about is the tech sector. So I was wondering if you could kind of give us a little overview of where do tech stocks stand right now?
Well, the whole thing is very fragile for a simple reason. The Federal Reserve raising rates traditionally puts pressure on stocks that trade at very high multiples or that don't make any money or make very little money. Traditionally, these are tech stocks. And there's a technical reason. It has to deal with the way the stock market, the way analysts value stocks. The stock market is basically a play on a future stream of dividends and earnings, and potential earnings that are out there. The problem is we don't know if they can deliver on earnings. So we make guesses about how much earnings we think these companies can throw off. And sometimes they're right, and a lot of times they're wrong. This is called fundamental analysis. And when interest rates go up, it reduces the present value of that future stream of earnings because you have competition from bonds. So tech stocks traditionally have very high growth rates on earnings and throw off a lot of cash flow. So they get affected a lot when interest rates suddenly go up. Now, if the economy is still strong, again, the impact may be very small. But there's a lot of companies out there, think of all these Cathie Wood stocks, that make little or no money at all, and in many cases lose money. And in many cases, they're not projected to make any money for years. This happened in 2000. And all of a sudden, people suddenly say, you know what, I don't know if I want to sit around waiting 5 years for this company to actually make any money. I saw a big run up in 2018 to 2020 and 2021, and I'm not interested in sticking around. These are called momentum traders, by the way, and they get very impatient when rates go up. So you can have a company where the fundamentals are still very good, but it doesn't have any prospects for making money several years from now, and nobody cares. So the fundamental story hasn't changed. It's the valuation story that's changed. It's the question of, again, it's like that hotel room, or it's like buying that used car. Oh, I think this is a great used car. I love this used car. I'm just wondering whether it's worth it to pay that price. I still like the car. I'm just haggling over the price. That's the same way with the stock market. You may still love Teladoc or something else, just Twilio or something like that. You may think this is a great company with a great future, but is it worth it at that price at that moment? A lot of people said in the last 2 months, no. Doesn't mean it's a bad company, though. You see, this is how the stock market works, very sort of, dispassionately in a way. So if we can keep the economy reasonably strong, remember, still tech is still winning. Software is eating the world. It's becoming more important, not less important. So that's the big advantage for technology stocks. The question is, are they still worth the prices? They've already gotten a lot cheaper. That's good news for the markets overall. You want to be able to buy lower. So tell us what the Fed's going to do this year. Tell us how strong the economy is going to be. Tell us what inflation looks like. And I can give you a good idea on where tech stocks are going to go. But, those are hard to figure out right now.
Yeah, I know it's something that a lot of people will be watching closely as all of those things play out this year. So another topic that people are interested in is cryptocurrency. Cryptocurrencies like Bitcoin have been bouncing back today, but they have seen a sell-off recently. Can you kind of give us a little bit of an idea of where things stand for cryptocurrencies right now?
Well, first of all, you should know I am very neutral on cryptocurrencies. People want to know what I think of Bitcoin all the time. You'll be a lot happier if you stop trying to figure out what Bitcoin's price is, because you don't know. Nobody does. These kinds of investments are not tied to anything fundamental at all, unlike the stock market or the bond market. This is the same with collectibles in general. It's the same with gold. What's gold worth? There's no fundamental analysis on gold. It's a lump of metal. It's worth whatever anybody thinks it's going to be worth. You could say it's a hedge against inflation. By the way, there's not very good evidence for that. But it is a store of value, gold. But, how do you trade on it? Well, it's worth whatever and it won't pay. The same thing with any kind of collectible, coins, stamps. I collect rock posters. A lot of you know that from the 60s. I'm a 60s guy. What's a Jimi Hendrix poster worth from the Fillmore? It's not worth anything. It's worth whatever anyone will pay me for it, depending on the condition. And, whoever's in the market at that time who wants to buy a Jimi Hendrix poster. There's no fundamental analysis to do on a Jimi Hendrix poster. It doesn't throw off a dividend. It doesn't have a future stream of earnings. It doesn't do anything. It sits on my wall. What's it worth? I don't know. I'll go into the market and ask anybody want to buy a Jimi Hendrix poster, and somebody will make me an offer. And maybe I'll sell it, maybe I won't. So it's the same with Bitcoin, okay? So I am neutral. I'm totally neutral. I am a big believer in a tethered currency. I want a US dollar, digital dollar, and foreign dollar to reduce friction in monetary transactions. I think that'll satiate a lot of demand for a digital asset when we get that, a true one. I'm a huge believer in blockchain, decentralized finance, because that will reduce friction in financial transactions. We can use it for stock transactions, for settlement. We can use it for real estate transactions. We can use it to send money to your friend in London. It's shocking how much these big banks charge to you send $1,000 to your friend in London, you get a 3 to 5% VIG just to do that. It's ridiculous. I'm a big believer in DeFi, decentralized finance, for that reason. So with that said, why have they been falling? Well, people, what happened to Bitcoin? It went up something like 400% between the end of 2019 and into 2020 and 2021. Now it's still up, I don't know, 300% or something. Even down, you think it's down, but actually it's up enormously in the last 2 years. So Bitcoin is not immune from this. It's a speculator game here. I don't care what anybody says about a store of value. You're kidding me. There are people sitting on enormous gains who bought 2 or 3 years ago. These people may have individual reasons why they want to take profits, so it certainly makes sense. If they don't think the thing's going to go up much and they bought in 2019, it would have been a very good time to sell, because for sure you're going to be sitting on an enormous amount of profits. So this idea of, HODL and all of that stuff, that's a nice idea. But when you're sitting on 400, 500% gain and you're not so sure this thing's going to do anything in the next year, there are very good reasons why you should consider taking profits. So they are not immune to speculative activity, I guess is what I'm saying. And remember, some companies, some countries are restricting trading in it as well. And we don't know where it's going to go ultimately. So don't ask me what Bitcoin is worth, because I don't know, just like I don't know what my Jimi Hendrix poster is worth. But cryptocurrencies are not immune to speculative activity. And ultimately, that's still what's going on.
Yeah, I think that's really helpful information, Bob, so thank you. The last thing that I wanted to talk to you about is kind of like the future of the workplace. I know you've been in the office at the stock exchange. I've been working remotely for the past couple of years. So I just wanted to get your perspective. How have people been returning to the New York Stock Exchange? Are most people back? And how do you think the workplace in general has changed because of the pandemic?
Yeah, it's a complex question. For the stock exchange, the floor is back, but there's an enormous infrastructure that supports the New York Stock Exchange. About 1,000 people who actually work not on the floor, but we call them upstairs, above me. 17 floors above me. And most of them are not back, but they're coming back. So the NYSE is calling people back Tuesdays and Thursdays now, and we'll see how that goes. I suspect it'll be okay, but slow. My long-term, what I see here downtown, I work down, this is Wall Street, literally. Wall Street is literally outside. I'm on the other side of this wall. Wall Street was coming back in a big way in December. Then Omicron hit and everybody left. January, all of Wall Street worked from home. I came back in the middle of January, there was nobody on Wall Street. It was empty. The delis were empty. My bagel place, there was nobody in it. And now I see people coming back. I see the banks starting to call people back, but it's going to be slow. This is 2022 will be the year of the transition. It will be the year of partial work from home, partial go in. I think 2 days a week is going to be very typical, like the NYSE. You're going to see. I'll tell you what I think is going on. There are two groups of people who don't want to come back. Number one are the groups of people who've had 1 hour or 1.5 hour commutes for 20 years, and they're all of a sudden they have an alternative they never had, and they realized, oh my God, I'm spending 15 hours a week in a car, and it's kind of a waste of time, or even on a train. And gee, if I have an alternative, I'm going to take it. That makes a lot of sense to me. The other group I never thought about. There is a very large group of people, and we don't even like to address them because we always assume, oh, we're always interested in, going in and hanging out with people in the office. There's a group, I call them the passive crowd. They never liked the office. They never liked going into an office at all. They didn't want to sit around backslapping the CEO and climbing the corporate ladder so they could get promoted. They don't care. They don't want to sit around the water cooler talking about the Jets game Monday morning. They don't care about that either. And they sure as hell do not care about going to boring office meetings that don't accomplish anything, sitting around for an hour and a half when they could be on Zoom doing it and doing something else at the same time they're in the meeting, and the meeting is shorter and they're doing something else at the same time. I never thought about that group, but now I see them because I hear from them. And I don't know how big that group is, but it's big. I'm guessing it's at least 30% of the people who go into offices. So you put this 30% together with, I don't know, what about those people who are fed up with the commuting? It's got to be 25% at least. You get more than half of the office workers have a very strong reason why they don't care if they never go back at all. Now, they're going to bring some people back, and there will be reluctance, but I think a very large number of people are going to be back at least 2 days a week before the end of the year. Here's what's going to happen a year from now. You're going to see headlines written by people in the financial press, that would be me, that it's going to say this: people who come into the office more get promoted more often than people who don't. There's going to be a hue and cry. There's going to be lawsuits. People are going to sue. You promoted this guy over me because he came in 4 days a week and I only came in 2 days a week, and that's discrimination. And what's going to happen? I have no idea. But I guarantee you something like that is going to happen some way. And that may force a few more people to get paranoid and come in a little bit more. My point is about this whole thing is this is a great experiment that has not ended, that we are still in the middle of. And I have seen the benefits of this myself. I think one of the reasons corporate America is not furiously demanding people come back is the productivity has not dropped. In fact, in many cases, a lot of you know this, you're more productive at home. You're not less productive. Nonetheless, there's some reasons to be concerned about the lack of a corporate culture. It is real, it does exist. And people do benefit from interacting with people on a personal level. They just do. So I think that the answer is going to be a very prolonged, slow, hybrid work culture that I don't think is going to go away. I think all of us going back 5 days a week, I don't see that for years, if ever. I see 2 days this year, maybe 2.5 next year. And, you know, if the productivity levels keep up, we may have this hybrid thing as a permanent feature. It's going to be a very interesting watching this whole thing develop.
Yeah, I definitely agree with you. And I do think that it's going to be, for some people, just as much of a shock to be told to go back to the office as it was when they were told to go home. So it'll be interesting, you know, those different types.
Well, what about you? You used to come in the office. Are you more productive at home or less productive? Or are you just as happy? Or, I mean, you're a good spokesperson for your generation.
Yeah, I mean, I never would have thought that we'd still be working from home 2 years ago. But I do think that productivity has been, you know, higher probably than it was in the office. And I think that I like kind of the hybrid future that I'm seeing. Go in a couple of days, but also be able to work from home. It's all about flexibility.
Yeah, well, that's what you're going to do. And you saw what happened. I don't know if you noticed, like 4 or 5 months ago, there were some Wall Street people, old school Wall Street CEOs, who said, we want people back in the office, and this is not a negotiation. Enough of this touchy-feely crap. We want people to come back. And they got a lot of shit. They got a lot of blowback from people saying, oh, you know what? Maybe we'll go to another firm. And there was some question about talent drain. So that kind of quieted down. That's a sign that this is a sensitive issue. And that's why I think this is going to take a while. I think it's going to be slow. And I think 2 days is going to be the new paradigm for a while. That seems very reasonable to me. 2 days. I mean, I have to be here because I have IPOs myself, but I often do work from home on Fridays. So, you know, flexibility is the key. I agree, Katie.
Yeah, for sure. And I mean, look at what we've been able to do virtually. So this has been great. Yeah. But thank you so much, Bob. Thanks to everyone for sending in your questions.
As always. Been an incredible week, folks. Put this down on the record books.
Certainly a lot to talk about this week. So thank you, Bob, and we'll see everyone again in a couple of weeks.